Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and in today's video, we're going to be focusing on one of the most beaten down growth stocks within the stock market. Now, this is a bit of a different style from some of my most recent videos where I tend to focus on my portfolio and I tend to focus on more dividend related stocks, but this one seems to be a pretty good opportunity and I want to focus on it in today's video. Now, as always, if you guys do appreciate the transparency and enjoy this type of content, subscribe to the channel. I would really appreciate it. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. Now, with that being said, before we begin, let's start by taking a look at my portfolio dashboard. So in total, I've actually invested $53,411 in the portfolio and I've been continuing to do my weekly investments into it. Now, if you guys are following me on Patreon, it is currently free. I actually posted my most recent buys, even though they were at all-time highs for the market. Now, this year alone, I'm past the 18.5K mark, which is crazy. And in terms of dividends, I've already received $580 this year, but we're on track to surpass the 730 mark from last year. Now, in terms of portfolio value, we are sitting at basically a record high. Technically speaking, it is a little bit lower today. It's down 0.06% from yesterday, but it's still very close to that high I've had in my portfolio. My unrealized gain is inching towards that $20,000 mark. It's currently at $19,700 and my total return is at almost 37%, which I'm pretty happy to see. Now, in terms of dividend income, my portfolio is basically teasing me right now. We're just under $2,000. You can't be much closer than that. And going forward, I'm projected to be earning $1,100 per year, which puts my current portfolio yield at 1.53% or a yield on cost of 2.09%. Now, without further delay, the stock I want to be covering today, and you guys might have actually guessed it already, is Adobe, ticker symbol ADBE, and I think it's presenting a pretty good value proposition right now. So first, taking a look at the component return for the S&P 500, we can see the best performing stock so far in the S&P 500 for the year and the worst performing right here. So the first one we can see here is Seagate Technology. It's up over 127% since the beginning of the year. And then we have Palantir Technologies up almost the same amount. Now, flying all the way to the bottom, we can see that the worst performing company within the S&P 500 is currently the Trade Desk, down over 61%. And the next one is actually Lululemon, down almost 60%, which is crazy. Now, some names I expected to see here are Centene Corporation. This is in the healthcare space, just like United Health, so it's down 45%, which is also pretty crazy to see. Now, scrolling down just a little bit, we can find Adobe and PayPal as well. And the reason I bring up PayPal is because I do own PayPal in my own portfolio. It's currently down over 21%, and it's another company I've actually been considering adding more into my position, but we'll get to that maybe in a future video. For today's video, we are focusing on Adobe and it's down 21.44% since the beginning of the year, so it might be presenting a good buying opportunity right now. Now, hopping back quickly into my portfolio, for my current holdings, you can see that I don't actually own any shares in Adobe. It is a company I'm considering adding, but haven't made the move on just yet. Now, the main factor holding me back from adding some Adobe shares right now actually is my total holdings being at 21, which for me is a little bit high. I have been working to reduce this number over this current year. And so if I can get it down to 18, maybe 17, I would consider adding another position once again. So let's just start by taking a look at the performance. So you can see right here, Adobe Inc. is actually trading at around $350 per share, which is pretty low comparing it to its all-time highs. Just in the past year, its 52-week high is sitting at $557, so this is a pretty substantial dip from there. Now, Thursday after market close, Adobe actually did release earnings, which I believe were pretty strong, and we'll jump in and take a look at that in just a second. And after hours, it was initially up the company's stock price, but since then has dropped below its previous day's closing stock price. So taking a look at performance, in the past 6 months, it's down 8%. In the year-to-date period, it's down over 20%. And in the past year, it's down 35%, which is a pretty substantial dip. In the past 5 years, it's actually still trading down, so the company has had a very hard time, and if investors who purchase it here around this $500 mark would still be pretty deeply in the red even now 5 years later. Now, from its peak till now, which was in 2021 till right now, it's down about 50%, so the company's stock price has actually been cut in half, which is pretty surprising. And before that, we saw a pretty substantial dip in 2022 as well, where the company's stock price was down over 60%. Now, what I want to point out is that the dip in 2022 actually presented a pretty strong buying opportunity. Those who purchased shares at the bottom were rewarded pretty heavily. It was up over 100% in just a couple months, which is pretty ridiculous to see. Now, since then, the stock price has trended down, but you'd actually still be in the green by a decent margin, up 27%, which is not bad at all. And that's why valuation matters a lot when buying these big growth stocks. In 2021, the company's stock price was clearly overvalued, which put it at risk of a correction, and that's exactly what we saw happen. Now, in general, historically, the company has been a fantastic performer in the market, up over 158%, and I still think that there's potential for more growth here, which we'll get into later in the video. So looking real quick at their most recent earnings report, they did beat on their revenue and they actually beat on their earnings per share as well, which is pretty good to see. In terms of earnings per share, it was $5.31 adjusted versus $5.18 expected, which is a pretty substantial beat, and revenue is $5.99 billion versus $5.91 billion expected, which is also great to see. In general, the revenue was able to grow at double-digit rates at 11%. I think for the current valuation, this is some pretty strong growth. Now, the guidance that the company gave, in my opinion, was fantastic. They revised both upwards, so the earnings per share was revised to $5.35 to $5.40, which is topping the estimates of $5.34 that analysts had planned. And for revenue, they guided $6.08 billion to $6.13 billion, while analysts expected $6.08 billion, so that's just on the low end of their guidance, so hopefully they'll be able to beat that as well. They're also expecting faster growth for their digital media business at 11.3%, and they've reflected that in their guidance. Now it's $4.53 billion to $4.56 billion, beating the estimates of $4.51 billion. Now, the big reason the company's stock price is down so heavily is from the big threats from AI, just like we've seen earlier in the year from Google. Now, in terms of Google has been able to perform very well and continue growing quickly, even with pressure from new AI startups and new larger AI companies, and so we'll have to see if the same can be said for Adobe maybe in a year or two. It will take a while to see how this plays out for Adobe and how the pressure from new AI startups and new AI companies relating to digital media are going to affect the company's fundamentals. Now, for me personally, I do believe Adobe is entrenched in the digital media space, and I think that the AI risks are overblown and that they're going to be able to incorporate some of these AI features into their own products over the next couple of years. Now, I do want to clarify these AI risks are very much real, and there's a reason the stock price is trading at a relative discount, and I think that's fair to see. However, if Adobe continues to perform as well as it's doing right now and the next couple of earnings reports are as solid, I believe the stock price will correct upwards very significantly. Hopping into their fundamentals, we can see right here some of their important financial metrics. So we have the revenue per share right here, and it's been growing very quickly over time, and the same can be seen for earnings per share and free cash flow per share. This company is a free cash flow generating machine, and they've been putting a lot of that free cash flow back into share repurchases. Scrolling down, we can see the effects of those share repurchases right here. I believe that this year alone, they're reducing their share count by between 4 and 5%. And as long as the stock price continues to remain low, they'll be able to buy back discounted shares, which is fantastic for shareholder yield. From 2013 till now, you can see how aggressively they've been buying back shares, and they've actually been accelerating this buyback program in the past couple years alone at these discounted rates. Now, if the stock price continues to remain depressed like we have seen so far, with the cash they have on their balance sheet and the amount of free cash flow they generate per year, they're going to be able to buy back a lot of shares at these discounted prices, which I think will be very good for shareholders in the long run. Now, a big concern that many investors have can be seen right here. The free cash flow versus stock-based compensation graph does a very good job illustrating it. The stock-based compensation, even though a small portion of free cash flow, is still very large for a company of this scale. Because of that, a lot of the GAAP metrics like the price to earnings ratio are not as accurate because they're not factoring in the effects of stock-based compensation, which makes the company a little bit more expensive in reality than it seems. Now, for the most part, I do believe that stock-based compensation is under control. They're able to generate a large amount of free cash flow, and I hope that over time this will start slowing down, but it's a little bit similar to Google. Google has a large amount of stock-based compensation, but is still able to perform and grow very well. Now, the reason this graph right here is blank is because they do not currently pay a dividend. If they ever start paying a dividend, you'll be able to see it right here, but I'm glad they're focusing this money into share repurchases instead of dividends because I think it's a much better use of their capital right now. Now, the company, of course, has very strong net income margins. They are a very profitable software company. It's close to 30%, and their capex is relatively low, but whenever they do find ways to invest their capital, they actually have pretty high returns. As you can see right here, their ROIC is at almost 30% in the past couple years. Now, hopefully they'll be able to invest back into the company into some of these AI-focused tools and softwares, and that way they'll be able to have this high return on invested capital for those programs as well. Now, hopping into Seeking Alpha, there's just a couple more metrics I want to focus on right here before we do wrap up the video and I give you guys my final thoughts. The first one here is the valuation metrics, and you can see that the PE, the price to earnings ratio for non-GAAP, is about 17.24, and a forward-looking basis even lower at 16.85 because the company is expected to grow pretty quickly. Now, what I was mentioning earlier is in terms of GAAP metrics, it's actually not as pretty, and that's because it's taking into account stock-based compensation, so 21.77 and 21.11 respectively. Now, even taking in stock-based compensation into consideration, I think it's actually still trading at a very attractive valuation in my personal opinion. Now, their growth over the past year is around 11%, and going forward, it's still expected to remain double digits, and if it's able to hold on, that'll actually be very strong, and the company will be able to justify its valuation pretty easily. Now, the big concern is, of course, what will the company look like 5 years from now? Will AI erode its moat, and will the company's growth start to slow down or even become negative and contract? Now, if you are asking me, my personal opinion is there is going to be some threat to the company's foundation, but I still believe they're going to continue performing well, and the AI is not going to be able to eat into their moat too heavily. Now, if you are asking me, I do believe that the threat is very much overblown. I think 5 years from now, Adobe will continue growing well, but we'll have to see how this video ages. Now, the last thing I want to take a look at here is their price to earnings ratio and their price to cash flow ratio. And as you can see right here, based on this, the company is basically trading at its lowest valuation in the past 5 years. Now remember, just because a company has a low PE ratio does not actually mean it's undervalued. And just because a company has a high PE ratio doesn't mean it's overvalued. It all depends on its growth rates and its ability to continue growing their earnings. Now, in the case of Adobe, I personally think that they're actually undervalued. I do agree with the price to earnings ratio being a good metric to value it. I think the company is performing really strong right now, and I think going forward, they're going to continue performing well. Because of that, this historically low valuation could present a very good buying opportunities for those looking to start a position in the company. Now, for myself personally, I'm going to continue holding off on starting a position in Adobe for the time being, but I will update you if any of that changes. And honestly, the only reason for that and the reason I jumped into the My Pie section of my spreadsheet is to show you guys how many holdings I already have in the portfolio. Right now, I'm pretty well diversified and I currently have a little bit too much holdings in my miscellaneous section, which is where I would fit in Adobe stock. My target allocation for each is 50% for my ETFs, 40% for my dividend stocks, and 10% for my miscellaneous stocks, which is where Adobe would fall into. Now, right now, miscellaneous stocks are heavily overweighted at 14.6%, and adding Adobe to it would actually make this even worse. So in order to manage my risk, I'm currently going to hold off on adding Adobe, but if I were to sell Uber, PayPal, or Amazon at any point, I could definitely see myself opening a position instead. Now, if I currently didn't hold PayPal stock and I was deciding which one to start a position in, PayPal or Adobe, I would actually be choosing Adobe right now, but because I currently hold a position in PayPal and I do believe in it long term, I'm going to continue holding my position and see how it plays out. As always, that does bring us to the end of today's video. I really hope you guys enjoyed the transparency and taking a deep dive into Adobe stock and seeing my own personal opinions on whether or not I'm buying the company at current valuations. If you guys did make it to the end of the video, let me know whether or not you already own Adobe stock or if you have any plans to buy it in the future. If you haven't yet watched last week's video where I talk about my dividend income for the month of August, check out this video right here. And if you want to see my high yielding stock that I wish I had bought more of, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.